While institutional investors in developed markets debate Bitcoin as a portfolio diversifier or inflation hedge, hundreds of millions of people in emerging markets are adopting cryptocurrency to solve acute financial problems that traditional banking systems have failed to address. The Argentine peso has lost over 90% of its value in 3 years. Global remittance costs average 6 to 7% despite the existence of technology that can reduce this to less than 1%. Banking exclusion affects 1.4 billion adults worldwide. Cryptocurrency is addressing each of these problems with demonstrable impact. For institutional investors, the emerging market crypto adoption story represents an investment thesis that is fundamentally different from developed market speculation. In Argentina, Nigeria, Turkey, and Venezuela, cryptocurrency is not an alternative investment class but a financial survival tool used by ordinary people to preserve purchasing power, access dollar savings, and receive money from family members abroad. This grassroots demand creates a more durable and structurally supported adoption base than speculative demand from developed market investors. This analysis examines the specific emerging market use cases driving crypto adoption, the institutional investment opportunities created by emerging market crypto infrastructure demand, and the regulatory evolution in developing economies that will determine the long-term investment landscape. The Argentina and El Salvador case studies illustrate two distinct emerging market crypto adoption models driven by different primary pain points. Argentina's crypto adoption is primarily driven by currency preservation. Argentine citizens use USDC and USDT as informal dollar savings accounts to protect purchasing power against a peso that has depreciated catastrophically. This demand is structural, not speculative. Argentines who hold peso savings face certain purchasing power destruction, creating strong rational motivation for stablecoin adoption. El Salvador's Bitcoin legal tender experiment is more complex and more controversial. The political decision to make Bitcoin legal tender was motivated by remittance cost reduction. El Salvador receives approximately $6 billion annually in remittances, representing over 20% of GDP, and average remittance costs of 3 to 5% represented a significant economic drain. Bitcoin was intended to reduce these costs. The experiment demonstrated that the fundamental use case, cheaper remittances, is real, but that Bitcoin's price volatility creates practical challenges for daily payment use cases that stablecoins would solve better. For institutional investors, both cases provide evidence for the stablecoin demand thesis in emerging markets. The stronger institutional investment opportunity is not in Bitcoin speculation in these markets but in the stablecoin infrastructure, payment rails, and financial services products that meet the specific dollar savings and remittance needs of emerging market populations. Chainalysis's Global Crypto Adoption Index consistently shows emerging markets dominating top adoption rankings when adoption is measured relative to economic context rather than absolute transaction volume. Nigeria, Vietnam, and the Philippines routinely rank in the top 10 globally, reflecting grassroots adoption driven by specific financial pain points rather than institutional investment activity. Nigeria's top-tier adoption ranking reflects multiple converging factors: a young, tech-savvy population, limited access to formal banking for significant portions of the population, a currency that experienced sharp depreciation, and entrepreneurial use of crypto for international payments in a country where traditional international wire transfers are expensive and unreliable. Nigerian crypto adoption is primarily P2P transactions and cross-border payments, not investment speculation. The Philippines' adoption ranking reflects a specific and well-documented use case. Play-to-earn gaming through Axie Infinity created a substantial population of Filipino crypto users who earned meaningful income from gaming, converting it to USDC or PHP through local exchanges. While the Axie Infinity economy has contracted significantly from its 2021 peak, the population of crypto-experienced users created a durable foundation for ongoing crypto financial services adoption. The remittance corridor from Filipino overseas workers is one of the highest volume cross-border payment flows in Asia, creating ongoing demand for crypto-enabled remittance alternatives. The remittance cost reduction opportunity is one of the clearest institutional crypto use cases because it quantifies the value proposition in straightforward economic terms. Current global remittance fees of 5 to 7% on $800 billion in annual flows represent $40 to $56 billion in annual fees that technology has the capability to reduce by 95% or more. This is not a theoretical future capability. USDC transfers on Solana are already operational, cost effectively nothing per transaction, and settle in seconds versus the 3 to 5 business days for traditional international wire transfers. The adoption barrier is real but addressable. The last-mile conversion from USDC to local currency requires local exchange infrastructure, banking relationships, and regulatory compliance that is underdeveloped in many target markets. Companies like Bitso in Latin America and Yellow Card in Africa have built this local exchange infrastructure, creating the complete remittance corridor from dollar-earning diaspora workers to local currency-receiving families at cost structures that are dramatically lower than traditional remittance operators. For institutional investors, the remittance opportunity creates investment theses across multiple layers of the stack: stablecoin issuers benefiting from growing circulation in emerging markets, local exchange and on-off-ramp operators building the last-mile infrastructure, and payment application layer companies that create the user interface connecting diaspora workers to their families. Each layer of the remittance stack represents a distinct institutional investment opportunity with different risk profiles and return characteristics. The Emerging Market Crypto Investment Framework identifies the 4 layers of the value chain where institutional capital can be deployed with distinct risk-return profiles. The stablecoin infrastructure layer is the most conservative institutional entry point because it represents existing regulated businesses with growing emerging market demand rather than startup execution risk. The local exchange and on-off-ramp layer offers the most differentiated institutional investment opportunity because this layer has the strongest competitive moats in emerging market crypto. Building regulatory relationships with central banks, obtaining money transfer licenses in multiple jurisdictions, and developing banking relationships for local currency settlement requires years of effort and creates significant barriers to entry. Companies that have successfully built multi-country emerging market exchange infrastructure have durable competitive advantages. The payment application layer carries the highest growth potential and the highest regulatory risk. Consumer remittance applications operate in the most heavily regulated segment of financial services and face regulatory evolution risk in every market they serve. Institutional investors in this layer must price in the possibility that regulatory changes in a key market could require significant product redesign or temporary operational suspension. The Emerging Market Crypto Risk Framework adds dimensions of regulatory, currency, and infrastructure risk that are specific to developing economy investments. These risks are not unique to crypto. They characterize all emerging market investing. The crypto-specific element is that the same conditions driving adoption, currency instability, and banking system weakness, are also conditions that create heightened regulatory and operational risk. Regulatory hostility risk is particularly relevant given recent history. Nigeria, despite having one of the highest crypto adoption rates in the world, has periodically banned crypto exchange access for Nigerian bank accounts, forcing the crypto market into P2P channels. These regulatory moves create operational challenges for formal businesses in the crypto space while often failing to significantly reduce grassroots adoption, which simply moves to less formal channels. Institutional investments in formal emerging market crypto businesses must price in the possibility of regulatory disruption. The adoption volatility risk cuts both ways and creates an important scenario analysis requirement. An investment thesis predicated on Argentine hyperinflation driving USDC adoption must include a scenario where an IMF-supported stabilization program reduces inflation and reduces the urgency of dollar savings demand. Structural demand from remittances is more durable than crisis-driven demand from currency instability, which makes the remittance infrastructure thesis more resilient to improvement scenarios than the currency preservation thesis. Emerging market crypto adoption represents one of the most structurally compelling long-term growth stories in the digital asset ecosystem. Unlike developed market institutional adoption, which can be slow, compliance-intensive, and vulnerable to regulatory reversal, emerging market crypto adoption is driven by the financial survival instincts of hundreds of millions of people who need solutions that their banking systems are not providing. The investment opportunity in emerging market crypto infrastructure is real but requires the same rigorous country-specific analysis that characterizes successful emerging market investing in any asset class. The generic emerging market crypto thesis, simply that adoption is growing, is insufficient for institutional investment decisions. The specific regulatory environment, currency risk, competitive landscape, and adoption scenario range in each target market must be evaluated with the same precision applied to any other emerging market investment. For institutional investors building digital asset programs in 2024 and beyond, emerging market crypto infrastructure represents a diversification opportunity that is genuinely uncorrelated with developed market Bitcoin speculation. The drivers of emerging market adoption, currency instability, remittance demand, and banking exclusion are independent of the institutional sentiment cycles that drive Bitcoin price volatility in developed markets. This structural independence makes emerging market crypto an attractive complementary component of a diversified digital asset institutional program.